is actually proven to be false, okay? And I know in a lot of areas of life, as I get older, I'm realizing less is more. Investing is absolutely one of these areas where less is more. And there's really no necessity to follow the stock market every day. There is no need to follow out to figure out what's happening at different companies and their stocks like Apple or Tesla. And right now, I as an investor, am extremely grateful for that because no one has any idea what's going on when it comes to different companies. I'm going to share with you a really great hack, something that I share with my students, and it's a much easier way to invest than investing in individual stocks. Some of you may have heard of something called ETFs. So they're often also referred to as index funds. And essentially, these are bundles of investment securities, and they allow you to invest in the entire market. So this entire market can be stocks, it could be bonds, like in U.S. stocks, Canadian bonds, vice versa. It could be Australian mining stocks. The sky is the limit. Okay, and the way I like describing this ETFs, if you have one fruit, that would be the equivalent of one stock versus a fruit salad, which is an ETF. So in fruit salad, you have lots of pieces of different fruit. And so in an ETF, you have lots of stocks or bonds or whatever it is mixed together. And as you can see, there is absolutely no stock picking involved here. So this is a photo of me living my best life. This is 2 summers ago. I was hiking in the Canadian Rockies. And the important thing here is that I'm not wondering what is happening to my investment portfolio. I'm not married to the stock market because I've invested using ETFs and I've put together a portfolio that's robust, and I know it can do its thing. It doesn't need me to micromanage it so that I can continue living my life, coaching you ladies, traveling, doing everything that I love doing, and you can do the same. Your investing doesn't have to take over your life. The second myth is that you need a lot of money to invest. I'm going to tell you that it is possible to become financially secure even if you're starting with small amounts. So I put this photo of a cute little librarian because there are stories of librarians who, on their modest salary, have become uber wealthy, like donating to charity, helping friends and family with financial troubles, etc. So really the point here is that successful investors add money periodically to their portfolio over time. Okay, that's important. That periodically could be weekly, it could be monthly, quarterly, a couple of times a year, but done on a consistent basis. It really adds up. So don't think that because you're on a modest salary or you don't have a lot saved up that you can't start. You absolutely can. And so the reason we think that we need a lot of money is that in the past we did need more money to invest, but today we can start with as little as $500. There are great online tools and apps that are meant for retail investors, so people like us. And some of my favorite tools of this sort is the online brokerage account. So this type of account is really your portal to riches, okay? I kid you not. A lot of people are in love with this style of investing, and it's actually called, if you want to look it up later, it's called DIY investing. Okay, so if you ever heard of that, that is the kind of investing that I engage in and that I coach my students to do. And the reason so many of us love this method is because it gives us the power to invest in a way that is best for us. So we don't need to ask the permission of a financial advisor or someone at the bank. We can just go in and trade the way that we want, in a way that feels right to us. And you can do this, using stocks, bonds, ETF, pretty much any investment under the sun you can buy through an online brokerage account. Okay, so I'm going to give you a little exercise. You can do this later, just like you can take a screenshot or a photo with your phone. This is step-by-step guide to opening a brokerage account. I get a lot of questions from women about this. I don't know who to go with. I don't know which brokerage, how to open a one up. So, all the major banks in Canada have brokerage houses associated with them. And yeah, you can just follow these steps. This is a high level sort of overview. With my students, I dig deeper, but this is, something to get you started if you're keen on, taking advantage of the current financial situation. So an online brokerage account, what does it actually look like inside? So this is a screenshot that I took a while ago. So these numbers are not up to date. I have a suspicion they've changed drastically. But yeah, this is the trading platform. This is, happens to be TD's trading platform. So there's a lot of numbers here. There are charts. And it can be, honestly, I realize that it can be daunting for a lot of people, a lot of novice investors. And because of this, a lot of women are actually shy away from DIY investing because we typically like knowing what we're getting into. Okay, so we want to know what all these numbers mean, what the charts mean. And so that's why I do a lot of screen sharing. This is really something that's like lacking in the financial marketplace and financial education marketplace. So if you're feeling that you have not found the resources that you need up to date, you're not alone. And this is why I created my coaching program, where I go over things like this, and we go over, I kind of like hold my students' hands and we look at things like this together. I do screen shares. So yeah, just to let you know that, it can be daunting, but, there are fortunately increasing number of coaches like me. Not enough, but we're sort of slowly getting there. Myth number 3 is that I can always start later. Okay, so I can always start investing later. It's very easy to put off investing for retirement. I get it. I know it's not exciting or sexy, but the sad truth is that women are twice as likely to be in poverty at retirement. Okay, and the reason is because we are not investing nearly as much as we should. Time is really our greatest asset when we're growing our wealth. Okay, so the earlier you start, the better. The younger you start, the better. And it's really kind of like, the way I like describing this, it's like a snowball. Okay, so when the snow is just perfect and sticky, even little kids can make massive snowballs. And the reason is because it's the exact same thing as the concept of compounding in investing, is that the ball rolls on itself. The money grows on itself. Okay, you just need a long enough runway. Okay, so the little kid that starts with a tiny little snowball just needs a long enough runway to make a big snowball. And for us, our runway is time. Okay, so give yourself the longest possible runway. If you didn't start when you were, a teenager, it's fine. Just start today. So this is a chart that kind of depicts this this concept of compounding and time value of money, which you may have heard of. Let's say you aim to have something around $1 million by the time you retire at age 65. Okay. And by the way, that sounds extravagant, but if your retirement is sort of 20, 25, 30 years away, that's like easily what you'll need at that point, if not more. So let's say you're aiming to have something around $1 million by the time you retire. If you start at age 20 to save your money and invest it in the stock market, you will need to put aside only $37 a week. Okay, so that's like a couple of shifts. If you're like, 22 or whatever, there's a couple of shifts at like kind of minimum wage job. If you wait to age 30 to start investing and to do the same thing, you'll need to put aside $89 a week, okay? But if you wait to age 40, that number grows to $224 a week, and the numbers on top of the bars are what you need to put aside a month. So by the age 40, you need to put aside nearly $1,000 a month in order to get to that $1 million mark. Is it impossible? No, but by starting early, would have made your life a lot easier. So if you are young, start early. If you're a bit older, don't panic. I have some like advice for you. Do not panic. There's still time. All right, so I recently updated this slide deck, and I added this chart just to show you kind of what's happening right now. Yeah, this was a couple of weeks ago, so at best this line on the blue line, squiggly line on the right, would have maybe had a little bit of an upward, finish. But essentially, this is what the S&P 500 index, how it performed over the past 90 years. Okay, 1990. Okay, so since before 1930. And S&P 500 is an index I really like talking a lot about because it is a representation of the U.S. economy and the U.S. stock markets. And even if you're in Canada, which I know a lot of you are, I am as well, I like this index because it is a very well-rounded stock market and index, whereas the Canadian stock market TSX has some kind of issues like having a lot of exposure to commodities, okay, which makes it a little bit more risky. So the S&P 500, even though we're in Canada, is like a really good place to start from. Let me just move this here so I can see my notes. So what conclusion can we gain from this chart? One is that the markets always come back. Okay, so there's an upward trend here over the past 90 years. If you get on at one point and stay on long enough, you're pretty likely to have your wealth increase. Okay, you're pretty much almost guaranteed, although I can't predict the future. If we look at what's happened in the past, this upward trend is clear. Okay. The second thing is that the best days in the market are right after the worst. Okay, so the lines where we see the blue line going sharply downwards, right after that, we see the sharpest upwards lines. Okay, and that's really what we want as investors. We want to get benefit. We want to get a hold of those upward lines. We want to ride those upward lines. Okay. Okay. So like, why should you start investing now? If you wish you started investing years ago, this is really your chance to make up for lost time. This is also a great time to get a head start if you're younger. This is also a buying opportunity that seasoned investors, so people like me, that we've been waiting for. So to be clear, we haven't been waiting for all the doom and gloom that's happening and the suffering, but we have been waiting for equity prices, so stock prices, to kind of like cool down a little bit, and that's really what's happening. So if you haven't started investing, now is a great time to get in. If you have investments, this is also a great time to improve your game plan for the future. And just by the way, this chart, for any of you geeks out there, it is adjusted for inflation, and it is also on a logarithmic scale, which means that these numbers on the side are not equally distributed. If they were, it would be a lot more, this chart would be a lot steeper. This is kind of a more conservative version of what I could have shown you. All right, this slide here I really love. A friend of mine who works for a big pension fund in the US shared this with me, and I wanted to include it in this presentation for you ladies this morning or this afternoon. So what is this? Well, what do I want to explain here? Timing the market. People ask me, should I wait to invest? Should I try to like time the market? Meaning, should I try to get in at a certain time and maybe get out before the market crashes? Here's my advice. Don't do it, okay? Because when the market comes back, it comes back with a vengeance. It waits for no one, okay? So in the time that you're kind of like figuring things out, like, has the market turned around or not, you will have missed out on lots of juicy investment returns, okay? And the truth is, no one knows where the bottom is, meaning no one knows, what the perfect time to get in is, except in hindsight. So basically, even professionals don't know. missing just the first month of the recovery. So the recovery is, once the market has kind of gone all the way down to the bottom, when it starts recovering, like going back up, even if you miss just the first month of the recovery, on average, you would have missed out on 28% returns. Okay, they're looking at all the recoveries since 1957. You would have missed out on average 28% returns. Okay, that's in itself is a huge number to kind of forego. If, however, in 2008, things are even more extreme. Because the bull market was just so long, meaning the upward expansion was the longest in history. You would have foregone in 2008, if you missed just the first month of the recovery, you would have missed out on 133% in returns. Okay, let that sink in. So we are at this inflection point where we can get these juicy returns or not. And if we like dilly-dally, we risk not getting on that bus, because it's really like a bus that comes every few years. You don't want to miss it. When it's on your way, just stay put. Don't go back into the house to like get, that chapstick or whatever. Just stay at the bus stop and get on the bus, okay? You will not regret it. And I don't want any of you to have to regret having missed out on these sort of fantastic returns. All right, let us see what else we have here. Myth number four. Fees don't make a big difference. Okay, so sometimes I run into people, women who think that it's investing through mutual funds is not the worst thing. Here's why I'm not a fan. Because they are notorious in charging high fees. And in Canada, unfortunately, we have some of the highest fees in the world. We pay easily between 1.5% and 3%, which in and of itself, it doesn't seem like a lot, but when it comes to investing, those numbers are astronomical. Okay, so I put together this chart, or I didn't put it together, I found it, and the source is below. So let's say you start with a $100,000 portfolio and you invest for 20 years, okay? If you invest with using funds that cost you 1% in fees over 20 years, so let's look at the green line. The blue line is what you would have made if you weren't paying fees. The green line is if you were paying 1% fees. If you were paying 1% in fees, you would have foregone $50,000 of returns. Okay, meaning you would have made $50,000 more. You would be $50,000 richer if you were not paying those fees. 2% fees. Let's look at that. That's nearly $100,000. That's the red line. That's how much you would have foregone. That's how much those fees would have eaten away your profits. Okay, I can't think of anyone for who 50K or 100K is not a big deal. And the truth is, we need it. Most people, everyday people, need that money for their retirement, okay? And you deserve to keep it because you've worked hard for it, okay? So the good news is there is a way out of paying these high fees, and that's through ETFs that we discussed earlier. That's another reason why so many people are fans of these things. ETFs, yeah, you still have to pay fees, but they're just a fraction of what you would pay using mutual funds. There are, for example, there are ETFs on the S&P 500, which we discussed, that charge 0.04%. And meanwhile, we're looking at like 1, 2, 3% fees for mutual funds. All right, so we're going to look at a story, and I really find the story of my student Emma pretty inspiring. So she started investing with me about 2 years ago, March of 2018. She then, in September of that year, she decided to leave her 9-to-5. And then she went traveling around the world. She's an avid climber, so she was climbing, like in the story, this photo here. She climbed around the world. And then she came back to Montreal, where she started a company called Climbing Escapes, where she takes groups of women out on women's empowerment retreats, and one of which I've been on and is awesome. Here's what Emma had to say about investing. Okay. And just to clarify, in the kind of 6 months before Emma left her job, from the time she invested to the time she left her job, she didn't become a millionaire through investing, but what it did change is that it changed her mindset, okay, regarding money, and it gave her a feeling of abundance. She started living her life from a place of abundance as opposed to a place of scarcity and fear, okay? And that allowed her to kind of take the leap, to take the risk, and quit her 9-to-5 to really strive for her best life. So this is what Emma had to say. I'm gonna just let you read it on your own, but I've underlined the word deserve, because if you don't feel like you deserve something in your life, chances are you're not going to attract that thing, whether it's, fitness, love, friendship, money. And so the fact that so many women feel that they don't deserve wealth and they don't deserve to have control over their money, holds them back. And the powerful thing about investing is that it is a great way to break through some of these mindsets, like it did for Emma. So I'm here to tell you that you can be a DIY investor, okay? So DIY investing is managing your money without the help of an advisor or anyone else. You can be a DIY investor. There are lots of people out there that are, most of them are men, and I'm here to help to bring up the numbers for the ladies. What do you need to be a DIY investor? So you need knowledge and you need confidence. Okay, those are the two things that you need, and those things are totally achievable. Okay, and so there's no reason to be afraid. Ideally you have some coaching, someone to guide you. Investing is a great way to not just grow your wealth, in your bank account, your portfolio, but it's also a great way to break through unhelpful mindsets regarding money. I've seen this with loads of my students. It's a great way to finally be in the driver's seat of your financial game. If you've never felt in control, once women start investing, a lot of them for the first time, they feel like they're in control. And it's also a way to gain confidence to make decisions that are best for your long-term happiness. So like Emma did, it just was a catalyst for changing her life. And that's why I wanted to share that story with you. And here we have our friend Nicki Minaj, who says, I want women to always feel in control because we are so capable. And truly, this is why I do what I do, because we are capable, okay? And all we need is some guidance to help us along the way. Okay, so if you are curious about my coaching program, I don't have time to go over it today, but I have a free class coming up on Thursday where I expand on what we've discussed today. So I'm going to be talking about my feminist origin story, if you will. So why I started my business. There is a story there, trust me. I'm also going to give you a roadmap for growing your wealth. So I'm going to share with you the steps that I share with my students. And I'm going to explain the online coaching program. So you're going to have all the information there. No need to email McGill Women's Alumni. You're going to have all the information there and how to contact me and all that jazz. And also, I have never done this before, but I was honestly really I was really happy that so many of you signed up for this class, and I was honestly blown away. This is the biggest group that I've spoken to. We're at capacity at 500, and I know a lot of women weren't even able to get in, but we'll deal with that later. So if you have friends that haven't, were not able to get in, you can tell them to attend. There will be a replay provided, but if you want to attend something like this live, you can go to this website, dahliawealth.com, to sign up for my Thursday class. where I expand on what we've spoken about today. But also, yes, exciting. I wanted to do something for you ladies today because I was really, I feel really lucky to share this hour with you. I have something coming up called the Money Mindset Workshop. It is brand new. And it is essentially us working on our money mindset, so our relationship with money. We're going to do exercises to break through certain unhelpful mind ideas and feelings on money, and we're going to create a new abundant mindset. Okay, I'm so excited about this because I've realized that sometimes financial literacy for women isn't just about a lack of information. It is really the way we relate to money, okay? And until some of these issues are taken care of, we will not truly be able to embrace money and wealth into our life. So that's why I created this. And I'm gonna be giving one lucky attendee a seat on this money mindset workshop. You can attend for free, and it's a $350 value. So if you want to join, or if you want to be in this draw for the money mindset workshop, sign up to the class, and then you'll automatically be added to the draw. And I'm going to be doing the drawing like right after this, like this afternoon. So it's only people who like register right now. So I'm going to give you I'm going to switch over to my other notes. I'm going to give you a moment to sign up to this. And yeah, I'm going to pick one of you to come attend this workshop with us. It's a collaboration that I'm doing with a certified mindset coach. So I think it's really going to be really great, and I'm really excited about it. So please do sign up to that. All right, I am going to just switch over. If you want to sign up to this class on Thursday, please do so. I don't know what's happening. I think, have I gone back to be the big screen? Just let me know. Like having a bit of technical difficulty. Yeah, okay, awesome. Just on webcam, that is what I want. And I am having trouble with my notes. Here we go. All right, so I put together a few notes for you ladies. There's a lot of questions that I've been getting regarding the current financial crisis and the correct market correction. So let's look at a few of these questions that I've been getting a lot of, and hopefully they will be helpful, answer some of your questions as well. Okay, so I've been getting a lot of questions regarding what stocks or industries do you recommend? We've never seen a pandemic like this in modern times. Okay, so last time we saw something like this, it was the Spanish flu, and that was literally over 100 years ago. Okay, it was in 1918. And I think we can all agree that the economy has changed drastically since then. Okay, so it's impossible to say with any certainty whatsoever what industry will be affected and which will do well. The truth is, even companies themselves are kind of at a loss to tell their shareholders how things will go. Right now, we've entered earnings season, which means it's time where companies tell their investors and the markets how much they expect to earn. And a lot of them are just at a complete loss. So and the other thing is that even professionals get it wrong. So there's if you enter into this game of trying to guess, do you really have the time and knowledge to kind of go through and do all the research and then follow this investment through? I heard something really interesting on a podcast, on the Freakonomics podcast, where they had a financial professional on, and he said, there's all these new risks that we didn't even consider 3 months ago. And investing is really about evaluating risk. So, for example, look at our own lives. I mean, how many of us thought that going to the grocery store to buy food and coming home with your groceries would be, you know, a potentially fatal risk for you and a public health hazard. Okay, I'm pretty sure it's zero. So, I mean, the same thing is true for market risks and risks involving companies. Okay, so what I suggest, and this is goes with my philosophy, my investment philosophy, and our what we teach here at Dahlia Wealth. In any case, is that picking and choosing specific industries is risky. Holding a diversified, balanced portfolio with all sectors of the economy is the best way to grow your wealth sustainably, okay? And to do it in a stress-free, hassle-free way. What I also get asked by novice investors what they should be doing right now. So it may be, the financial markets may be overwhelming for a lot of people right now. Okay. However, there's absolutely no reason to be scared. Like, it's not like if you enter the market, so you start investing, you're going to be eaten alive because you're a novice. It doesn't work that way. Okay. So, you know, yes, things are a little bit, you know, volatile right now, but especially if you're a younger person, your portfolio will recover. Okay, that's important to know. We saw those charts with the upward trend. Your portfolio will recover. Even if the market dips down again, it will come back up. So my suggestion is to not get caught up in headlines. Okay, so media is there to sell a product. We need to remember that. If it bleeds, it leads. Meaning, you know, kind of the more sensational the headlines, the more they sell their product. And it's also not unbiased advice, okay? So just be careful. Keep your consumption of sort of financial news kind of to a minimum. I mean, I have to keep on top of things, but even I kind of, you know, practice the same thing to not get overwhelmed. The other thing I would recommend to everyone, not just novice investors, is to have a plan in place. Right now is a great time to see the benefits of a plan. Most of the benefit my students are getting from me and my coaching services is right now because they have a plan. So yeah, you know, it's kind of like we're panicking, we don't know what to do, and it's at a time like this where it's great to be like, oh, well, no, we know what to do, we're gonna go back to the plan. Okay, kind of like if you go to the gym, you know, and you're not really feeling up to it, if you have a plan, you kind of don't have to think about it too much. It's like, oh no, I have this this outline and these exercises. I don't need to like rely on, you know, my mental fortitude. So that's why it's important to have a plan. And okay, let's say you're like, you know, Anjali, I really still believe in industry XYZ. Here's what I'll tell you. If you are really, really, you know, you're really convinced, it's not my job to tell you how to invest. As an investment coach, that's not what I do. But what I would suggest is, you know, we call it play money. Okay, so if you want to take a small amount of your overall portfolio, it could be like 3%, it could be 4%, but you know, I definitely would not go over 5%. You can invest it in this industry or the stock or whatever, but it definitely should not be the core of your investment portfolio. Another question I get, especially from people who are a bit older, I'm close to retirement. Should I be panicking? So as you get closer to retirement, what normally happens, especially if you have, you know, what normally should happen is that your portfolio allocation should shift. What does this mean? It means that your portfolio should be exposed to less and less risk as you get older. Okay, so either your advisors helped you with this or you've done it yourself. What this means is, in broad strokes, is that you increase your percentage in bonds and reduce in stocks. And if this has happened, you know, your portfolio should actually have been have weathered the past month fairly well. Also, the other thing to remember is that nothing magically happens at age 65. You don't like fall off of an investment cliff into an abyss. You don't liquidate your portfolio and sit on a mountain of cash. You still need to be an investor into your retirement days. A lot of us, you know, are going to have, you know, a 20-year retirement. The average lifespan for a woman in Canada is just under 85 years. So we still need to continue to be investors. You know, for example, my parents are in their 60s and 70s, and they're still very much actively investing. Another question that I get asked is, what is the better investment, stocks and bonds or real estate? And this is a question I get asked regardless of, you know, I get asked regularly, not particularly pertaining to the current situation. So the answer applies widely. So just comparing real estate to other asset classes. So other asset classes like stocks and bonds are the other biggest asset class, meaning category of investments. Real estate has a lot of additional costs, first of all, that most of us don't consider. So there's like maintenance, there are property taxes. We have a kind of like warm and fuzzy feelings about real estate because we can feel it, you know, their homes. But the truth is, as an investment, as a pure investment, they are a lot more trouble than a return that they provide. Okay, so kind of risk return balance is not necessarily in your favor. The other thing about real estate, it's not hassle-free the way stocks and bonds are. So let's say you own a condo building, you might have tenants that you need to take care of. You know, if their toilet starts leaking in the middle of the night, you need to send someone to fix it. So suffice to say, you know, stocks and bonds are not going to bother you in the middle of the night. And the other thing is that there's something called liquidity risk, where you might not be able to sell when you want to. Okay, like you know, some market conditions, you just won't be able to sell your home or your condo or whatever. It's just not the time where people are looking to buy, where there's a lot of buyers. So that, in which case you'll have to wait. And the other thing is that you cannot sell a portion of your investment in property. So let's say you run into some financial trouble and you need $10,000. You cannot sell a portion of a house. Where you can sell a portion of your investment portfolio. You can sell some stocks, you can sell some bonds. All right, almost at the end. I have two more questions, which we're going to go over. I get asked often if I can give tips on socially responsible investing. This is something that I see especially a lot of women really interested in, which is great. So we're lucky to live in an era where there are a lot of new socially responsible products coming out onto the market. Just in the past 5 years, there's lots of great ETFs that fall in this space. We spoke about ETFs earlier. There are green ETFs with, you know, looking at environmental factors. There are gender diversity products. There's a new product that looks at LGBT inclusion, which I think is really cool. It came out a couple of weeks ago. And you can find all of these things, or any ETF really, on ETF.com. It has everything, every ETF under the sun. When you are shopping around for our socially responsible product, here's what you have to look at. Here's what's really important. They are not all built the same. I mean, they are based on values, and our values are all different. Mine are slightly different to yours and to your mom's, and, you know, etc. So you need to look at the product you're dealing with and what their values are. What criteria are they managing their product based on? So for example, if you are an environmentalist, and you know, that's something that's important to you, that your investments are aligned with environmental, you know, in furthering environmental causes, you probably don't want an ETF that holds oil stocks, even if it is called socially responsible, which it happens commonly. So you really need to look under the hood to see, does this product match my own values? And finally, it seems like a lot of people are wondering why younger people today are having a harder time than their parents financially. So I thought I'd just answer this sort of general malaise / question. the truth is we are living in a time that is very different from generations before us, okay, when it comes to investing and saving for retirement and a lot of other things, but especially these things. Employers used to promise us a pension at retirement, okay? It's something that was called defined benefit contribution. So, you work for an employer for kind of like your whole life, and then at the end of it, they promise you a certain retirement, and you don't need to worry about investing because they've done it all for you. This is no longer true, okay? The kind of retirement pension that our parents and people before us had are basically extinct, okay? They are no longer relevant and in place. Employers no longer offer them, okay? Unless you work for the government, that's kind of the only holdout. But everyone else, we are on our own when it comes to ensuring that we have an adequate retirement and pension. Okay, now even if you are employed and you do pay into your company's pension plan, the vast majority of pension plans are called what's called defined contribution, which what it means is that you put in some money right now, maybe they put in some money as well, but then whatever happens later. You have to decide how that money is invested. And for a lot of us, and I remember even me when I was, employed and before I did my charter and all that, I was given a form by HR and I randomly checked off a bunch of boxes. Okay, so we really need to take control of the situation. We're not taught about investing at any point in our lives, but we absolutely need to be investment literate today. Okay, if you take away one thing from this, it is that it is vital to ensure that we live out our days comfortably. It is no longer a luxury, okay? And I think that most of you realize that, and that's why you're here. Despite everything that's going on in the world right now, it fills me with optimism that so many of you chose to be here. And it gives me hope that we will get out of these difficult times stronger. So I thank you for showing up. We're almost at the top of the hour. I thank you for showing up, for allowing me to serve you. This truly is my life's work, and it fills me with joy, and it keeps me going through these difficult times. Thank you for letting me be your investment coach for this lunch hour. McGill has told me that they will be sending out a follow-up email with some information, a survey, and also the option to donate to a student's cause for McGill students. So look out for that email. Sign up to my class, dahliawealth.com. I wish you luck in the draw for the money mindset workshop. Be safe, be well, and I hope to see you on Thursday.